My main goal for today's video is that no matter where you are right now in your trading journey, whether you are a complete beginner or someone that's just struggling to become profitable, by the end of it, I promise you will be able to easily spot major levels of support and resistance that can provide some highly profitable trading opportunities. And the reason I know this is that at the beginning of my trading career, I also struggled with support and resistance trading. I always overcomplicated it. But once I applied this three-step process you're gonna learn today, my support and resistance trading went from something I didn't even think was profitable to the most accurate and profitable trading strategy that I currently use. So in this video, we're gonna start with step one, which is what is support and resistance for those of you who are brand new, how they work. Then we'll dive into some common mistakes traders make around support and resistance. After that, we're gonna get into this three-step process, a ton of examples. We're going over full strategies, including entries, stops, and targets. We're talking about everything today. So if that sounds good, go ahead and click that like button, go ahead and subscribe if you are new, and I'll see you right after the intro and disclaimer. Welcome back. Let's go ahead and get started with what are support and resistance and how do they work. By the way, all the concepts I'm going to be talking about today apply in any market. I'm talking everything from Forex, crypto, all the way to the stock market. So keep that in mind as we go through this. Let's discuss support first. Support is a price level where the price of whatever asset you're trading, whether that's Forex, stocks, or crypto, pauses or completely reverses due to an increase in demand or buying pressure. Now, what causes this increase in demand or buying pressure? It's actually two different things. The first thing is that as the price of an asset decreases, the demand for that asset obviously increases. And to give you a really good example of this, if you have a TV here, I just bought a TV, which is the reason I'm thinking of this. If you have a TV here and this TV is currently selling for $1,000, but let's say Black Friday rolls around, there's a 50% discount. Now, instead of $1,000, this TV is now trading, or you can buy it for $500. There's gonna be a lot more demand and a lot more people interested in buying this TV at $500. Support works in the same way. As an asset decreases in price, the demand for that asset, again, whether it's a currency pair, cryptocurrency, or stock, increases. So that is one of the reasons that we see this buying pressure happen, is because the price of that specific asset is decreasing, therefore increasing the demand for it. Another thing that can help us find this level of support is the fact that price has used this level as support in the past. These are the two main reasons that we see an increase in demand or buying pressure to cause an asset, a cryptocurrency, a stock, or a currency pair to find support. We're going to discuss this in detail. Again, this is for those of you who are beginners to kind of understand what support and resistance are. Let's take a look at resistance. In the opposite way, resistance is a price level where the demand for an asset completely halts, and sellers come in, creating selling pressure and either causing a pause or a complete reversal in that specific asset. Now, in this scenario, imagine a TV was $500. And then because there was a lot of demand for this TV, they jacked the price up to $1,000. And let's say at $1,000, everyone stopped buying this TV. So the demand has went completely away. And in financial markets, just like with the TV, we have the option to sell. So whenever the demand stops, we see the lack of buyers combined with selling pressure causing either a pause like we see here and here, or a complete reversal like we see here. So that's the psychology behind resistance. Another thing that we look for whenever we're looking at resistance, and another reason that the demand dries up and that selling pressure come into play, just like with previous support levels causing more support when price gets to that level, a previous resistance level is something that could cause price to fall as well. So this is the psychology behind support and resistance levels. Now what I want to talk about is role reversal in support and resistance. Let's talk about that right now. Here's an article from Fidelity about support and resistance role reversals. A key concept of technical analysis is that when a resistance or support level is broken, its role is reversed. If the price falls below a support level, that level becomes resistance. If the price rises above a resistance level, that level will often become support. So this is the concept of role reversing, and the psychology behind that is what I want to discuss now. And we're going to step away from the TV analogies and just go with strictly price. So if price is pushing higher, we have a resistance level created here where demand slowed and selling pressure started, causing a pullback. Then we have a break of this resistance level and a pullback to that resistance level. The role reversal is when this resistance level then becomes support. But I don't like just stating facts. Let's talk about why does this occur. The psychology behind the role reversal is that people that started to, let's say, sell right here. Let's say they thought this was going to be the complete reversal. So they started to sell at this exact line. Well, let's say price dropped a bit. They got really happy because they were in their trade. They were making money, but now prices pushed higher. They didn't have a stop loss or anything to trigger them to get out of the trade. So prices pushed higher. At this point, what do you think that trader that was in selling short here? By the way, for beginners, when we sell short, we sell and we make money as price moves lower. So when price goes higher, that means we're losing money. So here, at this point, this seller that started here is going through a lot of pain. And they're in all this pain until they see what? Until they see the price of this asset push down to their original price in which they sold at. So at this point, since they sold from this level, they are now at break even right here. If you've ever been through a losing trade, you know that seeing money come out of your account and then seeing yourself back at break even is a pretty good feeling. Well, when they sold from here, the only way for them to get out of this sell position is to buy back into the market. So that creates an initial buying pressure from this level. And if we're going to continue in trend at this level, after that initial buying pressure from people that were short, that had sold, that are now choosing to buy back into that position, we can see an increase in buying pressure that can, in fact, push us into trend continuation. So for a role reversal, that's the psychology behind it. And essentially what we'll be discussing throughout this video is previous resistance oftentimes in an uptrend becomes support and continues that uptrend. Let's go through a really quick example of that on the bearish direction. So if we're looking at the bearish version of that in a very similar way, we have sellers pushing the market down in a downtrend. We have buyers stepping in and expecting a complete reversal. Remember, they don't have a stop loss or anything like that. So as price pushes lower, at this point right here, buyers are in a lot of pain. So they're probably sitting there, imagine yourself being in this loss, not having a stop loss set, and then you see price, you're down in your position, you see price push up and get you to a point where you can get out of your position for break even. At that point, you're probably going to decide to get out of that position. That causes selling pressure because if you buy into an asset, then you have to sell in order to get out of that position. So that causes the selling pressure, which is then continued if we continue in a downtrend. So that is the support turn to resistance side of role reversals. Again, throughout the video, we'll be talking a lot about support becoming resistance. There's the psychology behind support turning into resistance and support and resistance levels in general. Now let's take a look at some examples on real charts of both of these scenarios. First, let's take a look at an example of regular support. So we have the price of the Aussie Canada here on the daily chart of the Aussie Canada doing what? As we can see, the price of this asset is clearly pushing down and creating new lower lows. Now, price going down, that's a good sign that eventually we'll see support. But the way we actually find these support levels is by looking left in previous data and seeing where the last place this asset was supported in a major way. Where was that area? And that's pretty clear. If we're looking here on the Aussie Canada, we go down and to the left, it's really easy to spot this as the latest level of major support. And don't worry, we're going to go into some major detail on this a little bit later on. But again, I'm just trying to get beginners up to speed. So let's go ahead and mark off an area here around that support level. And let's click play on our market replay. As you can see, the price of the Aussie Canada recently came down to this support level and was supported here at this level, giving us a good example of regular support. let's now take a look at regular resistance on the euro yen. Here, as you can see, the price of the euro yen is getting higher. We're pushing into new highs. Now, although we know that the higher price gets, the less buyers are interested, and eventually we'll either get a pullback or a reversal. Again, the way we spot the exact area that this is likely to occur is by looking left at the last place price saw resistance from. So let's look left from where price is now. A great way to do this is put a horizontal line on that swing high. Look left, what's the next swing high when we look left? Right in this zone. So with that being the case, our zone of resistance would look something like this. And now we have an area that we can predict with a high degree of accuracy will cause either that pause or possibly a complete reversal of this asset. Let's click play here on the euro yen. As you can see, price came to the zone a couple of times and did in fact reverse, pushing lower, giving us a good example of regular resistance. Let's now take a look at the role reversal side of support and resistance on the Aussie New Zealand chart. Here on the Aussie New Zealand, what has happened? So if you'll remember back to our examples, we're looking at price making new higher highs and higher lows. And then once we break through a resistance level, what happens? That level of resistance oftentimes becomes support for that particular asset due to a lot of different factors, including the fact that a lot of sellers are in this area. And if price gets back down to this area, they go from being in pain to being break even. That causes initial buying pressure. If that buying pressure continues, the demand continues for this asset, that's what pushes it into trend continuation here in the uptrend that's already established on the Aussie New Zealand. Let's see what happens here after I put a horizontal line on the chart. Here's our area of resistance turning into, as you can see, support and pushing the price of this asset higher, giving us, again, a good example of the resistance turn to support role reversal in our support and resistance trading. Next up, we're taking a look at a bearish role reversal here on the Aussie Canada. So what do you see on this chart? Hopefully you are able to see that the price of this asset is in fact pushing lower and continuing to break below previous levels of support. What does that mean? That means that these previous levels of support, as long as we're breaking into new lows, is a likely area for price to continue in that specific direction. So with that being the case, we mark off our area of previous support here on the Aussie Canada. And what do we expect? We expect to see price come into this area and then continue to decline. Let's see what happens. That is, in fact, exactly what happens here on the Aussie Canada. As we push back into our area of support, it then becomes resistance, giving us a good example of support, role reversal, and becoming resistance. Now that we've been through a few examples of that, there's one more thing that you must know in order to identify levels of structure correctly with this three-step process you're going to learn in just a second. So let's dive into that one more thing that you need to know, and then we'll move on from there and talk about the three-step process to easily find accurate levels of support and resistance to give you highly profitable trading opportunities. There are actually two main types of support and two main types of resistance. There is counter trend support and trend continuation support, as well as counter trend resistance and trend continuation resistance. In order to properly identify these two different types of support and resistance, it's imperative that you understand how to identify trends on a specific asset. So let's talk about that now, starting with an uptrend. It's actually a lot easier than most people think to identify trends. If price is creating a high, followed by a low, followed by a higher low, and a higher high, what trend do you think this is? This would be known as an uptrend. So essentially, whenever we're looking for trends, we're just asking ourselves, is the most recent moves out of price, is it creating higher highs and higher lows, or the opposite? If it's creating higher highs and higher lows, we have ourselves an uptrend. And this is where a lot of people get confused. They say, well, what about the trends inside of the trend? And there are moments in pullbacks where pullbacks do this. But what you need to keep in mind is that this move from here to here, whatever the lowest low of this pullback to the new high is what we're paying attention to. And this is the low that we do not want to see broken by price. So we don't want to see this happen. If that happens, we would no longer be in an uptrend. But as long as price stays above this low, our previous higher low, and eventually creates a new higher high, then we have ourselves an uptrend. And if price was coming back to this level of resistance, what type of level would that be? Counter trend or trend continuation? Well, considering we're in an uptrend, this would be an example of bullish trend continuation support, which is a resistance level that's turning into support. Now let's go through a bearish example of trend continuation resistance. For trend continuation resistance, what we see for a downtrend is the opposite of what we just talked about. We see a low followed by a lower high, followed by a lower low, followed by a lower high, followed by a lower low. We're going to be taking a look at examples of this on a chart, but as you can see here, we do have price creating lower highs and lower lows. As long as this continues, we are in a downtrend. And when we're in a downtrend, if we're looking for trend continuation levels, that level is going to be our previous level of support that was broken, that trend continuation level being our trend continuation resistance level. So that's what our trend continuation levels are going to look like. Again, we're going to take a look on a chart in just a moment. But before we do, let's talk about counter trend levels as well. Now here, let's take a look at what's happened on our figurative price, which is made up of our blue lines here on the chart. We've had a low come up to a high, come up to a higher low, come up to a higher high, a higher low, a higher high, and then something happened, something I call a bearish rotation. As we pushed down, broke below this low into what could possibly be a downtrend, then we have a lower low, a lower high, and a lower low. This means we are in a downtrend. So if we're going down, if we're in a downtrend, then counter trend support would be a level like this that has the ability to push the market higher. And that's exactly what we have here. If I draw a horizontal line on the chart, you can see that this would be our counter trend level of support. It's a level below price while we're in a downtrend that is likely to cause a bounce or possibly a complete reversal. We'll do a brief example of the resistance version of counter trend resistance, and then we'll take a look at a couple of examples on the charts. In this example, you can see that we have a low out of price, pushing up to a high that broke above our previous lower high, meaning we're in what I call a bullish rotation. We then have a pullback to a higher low and a higher high. This is the point we can say we are definitely in an uptrend. At that point, we continue making higher lows and higher highs and higher lows until a level that we consider our counter trend resistance level. The reason this is counter trend is because the trend of this market is now in an uptrend, considering the way our highs and lows out of price are happening. So with this being in an uptrend, this would be our counter trend resistance level. And all that means is that this would be a level that is likely to push the market down for a pullback or either a complete reversal. Now let's take a look at a couple of examples of this on real charts. The first thing we're taking a look at is an uptrend. And what really helped me out when I first started trading, trying to identify swing highs and lows and trends in general, was just drawing them out myself. So here we have a low of price, pushing up to a high, pulling down to a higher low, pushing up to a higher high, another higher low, another higher high, another higher low, almost an equal low, but a bit higher than the last one, up to another higher high and down to what we assume is now going to be a higher low. At this point, what would you consider the trend of this market to be in? This would be considered an uptrend, right? And what makes it really easy after identifying that is we can now point out our levels while price is moving higher. I'll change that to black to make it easier to see. Every time we break one of these higher highs, that is considered our previous resistance level that could act as support. Every time we break above one of these levels, price is likely to pull back to it and create a bounce of some kind. These are our trend continuation levels of support, previous resistance, again, using that rotation of resistance turning to support in an uptrend. But that would be how you identify an uptrend. Let's take a look at a downtrend now on actual charts. So again, something that really helped me out was just drawing the lines myself. So if we go from a high here, we go down to a low, we have a lower high, we then have a lower low, we then have a lower high, a lower low, a lower high, and a lower low. This would be an example of a downtrend. And remember what we talked about with the bullish example of this, same thing applies here. We're looking at these previous lows to become resistance. And One of the mistakes I see a lot is traders using these as just lines. They're not lines. They're going to be zones of support and resistance. But as we continue breaking below these lows, they do continue to act as resistance for a downtrend. So these would be our trend continuation resistance zones as price pushes lower. Now we're going to take a look at an example of counter trend support. So as we can see, the price of the Aussie New Zealand here on the daily chart is in fact pushing lower, creating new lower lows, lower highs, lower low, lower high, lower low, but we actually bottom out here and then begin to push higher. And if I unscroll the chart a bit, you'll see that. So at this level, let's draw a horizontal line. And if we look left from our horizontal line, what can we see? Well, we can see the reasoning that there was so much buying pressure that built up in this area, and it was because of our counter trend support level right here. But again, in order to identify that, you need to understand how to identify this downtrend first. That's the reason we're going over trends in this section of the video. Let's take a look at one more example of counter trend resistance, then we'll move on. Here we can see the price of the Aussie New Zealand pushing higher, creating higher highs, creating higher lows. I did that the opposite, my bad, but you know what I'm saying. We have an uptrend here in this area. If we put a horizontal line here where price began to fall and scroll out a bit, so you can see that we did start falling from that area. If I scroll left here, you'll see that the reason for all that selling pressure was in fact our counter trend resistance area. But again, in order to understand counter trend resistance, you need to understand how to identify an uptrend before that counter trend resistance level actually happens. Okay, so now that everyone is caught up, we're about to dive into this three-step process I use to point out highly profitable levels of support and resistance. Right before we do, I want to take like 2 minutes and talk about the most common mistakes I see when it comes to trading around support and resistance. There's only 3 of them, so let's go ahead and jump right into them now. Mistake number 1 is having support and resistance as just a line on the chart. I talked a little bit about this a second ago. Support and resistance are not lines. They're going to be areas in the market that create resistance or support. Having a line on your chart, the market does not care where your line is. You need this to be a zone of support or resistance in case price goes a little bit above it or a little bit below it, because that's going to happen more often than not. So just try to keep in mind that support and resistance, instead of just being lines, an exact price, support and resistance tend to be zones or areas where the market's likely to either go down or up, depending on if it's support or resistance. Now, that's going to be a bit subjective in terms of how big is your zone going to be. There's really no way around that. Sum of trading is inevitably going to be subjective. It's just something you'll get better at as time goes on and you gain more experience in the markets. Next, mistake number 2 is not having a consistent way to enter a trade inside of support and resistance zones. I know I dealt with this a lot whenever I was first beginning my trading career. I thought support and resistance would be like the holy grail. So anytime price got into a level of previous support that I thought could become resistance, I didn't have a trading plan or per se a trading strategy, so I had no consistency in the way that I entered trades inside of these zones, and it caused me a lot of heartache, lost money, and lost time that I want to help you to avoid. So remember, inside of these zones, our entire point isn't just to trade around support and resistance. You could know support and resistance like the back of your hand and still lose money in trading. Why? Because if you don't create a full trading plan and trading strategy that is consistent, and the way you trade it is consistent around these levels, then you're doing yourself no good watching this video and you're just wasting your time. So remember, and I'll teach you some of my most consistent ways that I enter into trades using support and resistance a little bit later in the video, so you'll have a good starting point. But just remember, support and resistance are not holy grails that you could just trade inside of resistance and the market's going to fall, or trade inside of support and the market's going to rise. You still need a strategy. You still need a consistent way of doing that. And next up, one of the things that gets on my nerves the most, and I say gets on my nerves, it's just something that I think really hurts beginners. It doesn't affect me whatsoever. I just know it really hurts beginners. And that is when you see a chart that looks like this. It's like, how do you even know where price is if you have that many lines on your chart? You may be someone who's had your chart look like this before. I know I have. Or you've seen a chart that looks like this and you just ask yourself, how in the heck do they even see anything on that chart? And that's a good point. I have no idea. And that's why today, what we're going to be doing is just placing two zones on any chart. We're only going to have two zones of support or resistance on a chart. That's it. We don't need all of these zones. It's ridiculous to have levels pointed out that are so far away from price. It's going to take a year for it to get there. So those are the three mistakes, most common mistakes that I see beginners make when trading around support and resistance to help you avoid them. Now, let's move on to the three-step process that I still use to this day and that creates some of the most highly accurate and profitable trading opportunities I've ever had using support and resistance. Okay, so now let's go through this three-step process and dive into a few examples of using it on real charts in real time here on the 4-hour chart. So this is price that hasn't happened yet. I'm not using market replay mode or anything like that. I'm showing you setups that actually exist right now when I'm recording this on June the 2nd, 2022 at around 11:09 p.m. Shit, it's really late. Let's go ahead and go through the process itself. Step number one is identify trend. This is the reason I took you through that trend identification section of this video, is because the first step in this process is to identify the trend of the market you're trading. Let's go ahead and do each of these as we talk about them here on the Pound New Zealand. What type of trend are we in? Well, price has been pushing lower, right? It's pretty easy to see that price is currently making lower lows, lower highs, lower lows. We've came from lower highs, lower lows, lower highs, lower lows, lower highs. So we're in a downtrend. So if we've decided that we are in a downtrend, step number two is to identify the trend continuation and counter trend level of support and resistance. This is what I meant when I said we're only going to have two lines, or not two lines, but two zones on our chart for support and resistance. We're going to have one trend continuation level, no matter what trend we're in. And we're going to have one counter trend level, no matter which trend we're in. Considering we're in a downtrend, our trend continuation level is going to be the previous level of support that was broken, which is right in this area. So we're just going to use a line for now before we go over the rest of the steps. The next thing we need to do is find a counter trend level. Now, how do we do that? Finding our counter trend level is something we have talked about a little bit already, but what essentially we're doing is looking for a level below the lowest low price has currently made for a level of support back here that price has been supported by in the past. That's what we're looking for. So let's zoom out a bit and see if we can find it. Does that look like a level that was used as support before in the past? Yes, it does. So we're just going to use a line for now right here. Again, these are zones and we're going to make them into zones in just a second. I just want to make sure you understand all three of these steps before I go into too much other detail. Number three. It's probably the most subjective part of this, but again, trading inevitably is a bit subjective, especially trading around support and resistance. So step number three is to ensure that the level we're trading is a strong level. Now, personally, I do that with in two ways. That's all. The only two ways I consider something a strong level is if that level caused a major move out of price. And to define a major move, I don't have like specific rules. Again, there's subjectivity in it, but it's pretty obvious to see this level caused a major move out of price, right? It caused a major move out of price multiple times. And ironically, the second way that I ensure a level of structure, support, or resistance is a major level is if that level has been tested multiple times. So I'm either looking for a level that's had a major move from it, like this, or a level that's been tested multiple times, which ironically, again, also happens here at this level. So to go through those steps one more time to make sure this is really clear, as soon as I jump on a chart that I'm planning to trade using support and resistance, this is the three-step process I use right now. I look at the chart, I determine the trend, I determine where's my trend continuation level, as in when we're in trend. The only thing I mean by that is if we're in trend, what's the latest level that was broken? That's my trend continuation level every time. I also ask myself, where's my counter trend level? The counter trend level is just whatever level for support. It would be whatever level is below price looking left, and then that is my counter trend level. After that, in order for me to be able to trade at these levels, because I may have these levels and they don't meet requirement number 3, which is they must be a strong level. So in order for me to trade these levels, they must have either created a strong move out of price or be a level that's been tested multiple times. Those are my requirements for levels of structure I'm going to trade around. So on the pound New Zealand, looking at live data right now, what I'm looking at on this chart is an area of structure right here, considering we're in a downtrend, that I will be looking for possible short trades in if we get a pullback into this area. This is my trend continuation resistance level that was previous support. This is that rotation level where this level has been acting as support for this pair, and it has acted as support for this pair multiple times. So that meets requirement number 3. It is a trend continuation level. Requirement number 2, I've identified the trend is down. Step number 1. So I went backwards with that. I'm slightly dyslexic. It'll be all right. You understand what I mean. But this right here between the area of 1.9284 and 1.9254 is an area I'll be looking for short trades inside of here on the pound New Zealand. As for my counter trend level, I'm looking at the area of support that looks like this. And that area is between 1.9109 and 1.9079. This is an area looking left that has been used by price. It is right below price. So it is my counter trend level, meeting requirements for step number 2. And it has been tested multiple times along with created strong moves out of price, meeting all 3 of my requirements. So using this 3-step process, you just saw me plan out essentially my next couple of days of trading on the pound New Zealand using structure, support, and resistance. Price will hit one of these levels eventually, and if I get an entry reason, which we'll talk about in a second when we get into the actual strategies using this process, if I get an entry reason in either our trend continuation area or our counter trend area, I will be taking trades based on those entry reasons, either going long from support or going short from our support turned to resistance level here. So that's what I'm looking at on the pound New Zealand based on this 3-step support and resistance process that you just learned. We're going to take a look at 2 other examples to ensure that you have a good handle on this process, and then we'll move on to creating full strategies around this process of spotting accurate levels of support and resistance. Here on the Euro Yen, let's go through our process. First off, what is the trend of this market at the moment? It is an obvious uptrend as we're creating new higher lows. I did it right that time. And new higher highs. So with that being the case, what's our next step? We've identified uptrend. Now we want to identify the trend continuation level and counter trend level of support and resistance. The trend continuation level is what? Nothing more than the latest level of resistance that was broken. In this case, the way I see price, and again, this is going to be subjective. It's just going to take you some experience and time in the markets to perfect finding the right levels. But what I see price doing is creating a high, a higher low, a higher high, a higher low, and a higher high. So this would be, for me, again, one of the ways to practice this is just go through and draw out lines on your chart. That's what I did at the beginning, and it turned me into a monster when it comes to figuring out these levels. But this would be my level of trend continuation support, which is that role reversal resistance turn to support. It's the latest level of resistance that was broken. Let's go ahead with the horizontal line right in that area. Let's now scroll back. What's the next thing we're looking for? We are now looking for counter trend levels. Since we're in an uptrend, that would be a level of resistance above current price. Right there is current price. Let's scroll left. Okay, we're right here at a level of resistance. Here's that level. So now we've pointed out our, let me move this to where you can see it. We've pointed out our trend, which is an uptrend at the moment. We've identified a trend continuation and a counter trend level. The last thing we need to see to ensure that we can trade around these levels is that it is going to be a strong level, which has the highest likelihood of pushing the market around. The way we identify that is, did the level we're looking at cause a major move out of price, or was it tested multiple times in recent price? And the answer to both those questions in both these levels is what? Go ahead and look at them real quick. See if you can identify whether or not we would place trades, or whether or not I am going to be placing trades around these levels in the future here on the Euro Yen. Again, I'm literally just setting up my next few days of trading here on these pairs using this process, and decided to do it with you to give you some good examples of this process itself. So here on our previous level of resistance that was broken, which we consider our trend continuation level, it's going to be a level of support. If we look left here, we can see that this level, in fact, was tested multiple times and did cause a major move. So that is a yes. Here on this level, this would be considered a very major move out of price to me. So with that being the case, this level is going to be a valid place, and is a valid place that I'm currently looking for possible short trades, expecting this level to cause the price of the euro yen to drop either a little in a pullback, which I can grab targets on lower time frames. If it does, that's totally fine, or possibly completely reverse from this area between 140 and 139.70. My trend continuation level on the euro yen is 138.1, between that and 137.76. Hopefully this is starting to make a lot of sense in terms of this three-step process and how I use it to point out major levels of structure, support, and resistance. Let's go ahead and move on to our final example, which is going to be on the pound Aussie. Most recently on the pound Aussie, what type of trend are we in? Well, we've had price pushing a lot lower. We've then had a lower high and then a lower low. This is screaming downtrend. So since we're in a downtrend, what's our next step? Our next step, if I bring over our three-step process, after identifying the trend, we now need to identify our trend continuation level, which is nothing more than the previous level of support that was broken in a downtrend, and our counter trend level, which is nothing more than the next level of support price will hit in a downtrend that could possibly cause a pullback or possibly a complete reversal. So in this case, what we have is price pushing lower. This would be the previous level of support that was broken to me. With that being the case, this is where, and you don't have to be perfect. Whenever I say subjectivity, this is going to tend to work whether you draw exactly the same levels as me. Don't try to draw the exact same levels as someone else. You're just going to get better at it with experience. But whether you draw the exact right level or you draw a level somewhere else is going to be nearly irrelevant. If you're pointing levels out like this, you're identifying trend, you're finding trend continuation levels that at least look somewhat like the last level of support that was broken, you're ensuring that it's either been tested multiple times or caused a major move out of price, the levels are going to be pretty accurate, even if they're not the same exact levels that I'm picking out. So the subjectivity is not a huge problem when it comes to identifying support and resistance. So don't get too caught up on that. I know a lot of people normally get caught up on that subjectivity. Try not to. But here, we have our trend continuation level pointed out. Let's go ahead now. And again, that trend continuation level right here, the latest level of support that was broken. Next, let's look below price. Here is our price, the lowest low price made in a downtrend. We want to look below the lowest low price made in that downtrend, and we want to find the next level of possible support, which is right here. Now we have to ask ourselves the third step question, which is it a strong level? So in order to do so, we scroll left just a bit. I would say that this level is obviously a strong level because of the strong move price made when it got to this level. And also, whenever drawing my zone, I'm going to try to encapsulate as much of this level as I can as well. And I might even pull this down just a bit. Again, the zones are going to be a bit subjective. And for this level, I actually see this as a major level as well, because if I make my zone, my box a bit larger, then it does encapsulate these two levels as well, making this a level that has, in fact, been tested multiple times, causing it to be a major level of resistance now, because it was previous support that was broken, now becoming resistance, this being my counter trend level. So on the pound Aussie, my trend continuation level after my three-step process is an area of price between 1.7410 and 1.7376. This will be an area that I will be looking for possible short trades if we get a pullback into over the next few days here on the 4-hour chart of the pound Aussie. My my counter trend level is down here between 1.7235 and 1.7185. This is an area I'll look for a possible bounce or complete reversal depending on if I get an entry reason. Again, we'll be talking about that in just a second when we go over full strategies, but this is the three-step process that I use to identify trend continuation and counter trend levels of structure that have provided me with some of the most accurate and profitable trading opportunities I have ever had. Now, on to the really exciting stuff. Let's start talking about a strategy that I'm going to be teaching you within the next few minutes that you can kind of take home with you and start to test on your own and demo trade and figure out if you want to add it to your actual trading plan in live markets. Before we do, I want you to understand what a strategy consists of and teach you how I build strategies, because that's going to benefit you a lot in the long run. So I build strategies, and first off, let's talk about the importance of having some type of way of building strategies. The consistency that you trade with is going to play a big part in your success. If you don't have a consistent way of trading, you're going to be inconsistent, and therefore you're going to lose money. There's no one that's ever been inconsistent in their trading and made a lot of money over a long period of time. So we got to get you consistent. The way we do that is by creating a trading strategy or a trading plan that is rules-based. Rules-based enough for you to follow throughout changing markets. And the way I do that is by something I call CEST. Every strategy that I trade was built with CEST. Let's start, and if my voice sounds scratchy, I'm sorry, I'm a little bit sick. But C, let's go ahead and get into this, stands for conditions. Examples of conditions are what we just talked about: structure, support, resistance, are indicators above, below a moving average, overbought, oversold on a specific indicator, or MACD lines crossing. Those are all examples of conditions, and those would be something that we would need to start with when we're starting to build a trading strategy. We want to set up good conditions for a possible trade. Good conditions for a buy trade maybe would be an oversold RSI at a major level of structure, and then the entry is what we need to focus on next. So conditions, again, are the things we need to see happen before we look to enter a trade, and they put us in the best case scenario, the best environment to win that specific trade, depending on the direction we're trading. So conditions for us, the good thing about this is that you already have the conditions for the strategy you're going to learn. Conditions for us, for the strategy you're about to learn, are identify trend, or this three-step process. It's identify the trend, identify your major levels using trend continuation and counter trend levels, and then ensuring that they're strong levels. Once price is in that strong level, all of the conditions are met for the specific strategy you're going to learn in a second. Next up, we have to focus on entry. Now, what are some different ways you've heard of someone entering the market? Before I do that, let me define what an entry is. Conditions are the things we look for before the entry. The entry is the reason you press the button. Remember earlier in the video when I said at the beginning of my trading career, I thought that I could just be at a level of support, press the buy button, and I thought the support and resistance were holy grails and the price of that asset would just go up. Unfortunately, I learned the hard way that's not the case. You need an actual rules-based reason you press the buy or sell button every single time, and you need to be consistent with it. So that's what we use an entry for. Now, why don't you try to think of a few examples of entries while I go over a couple of my favorites. A couple of my favorite types of entries are things like candlestick patterns. You've heard of a lot of these, I'm sure. Engulfing, shooting star, hammer. Or things like multiple candlestick patterns. Maybe I have a shooting star followed by an engulfing. Or things like chart patterns, such as double bottoms, double tops, head and shoulder patterns. You can go as far as to use the cross of a moving average or any other type of indicator signal. I don't know why that was so hard to get out, but it was. So you could have just price coming out of overbought, and when it comes out of overbought, that's your reason for sell. But regardless, what I'm trying to tell you is you need a set in stone reason, a rules-based reason. You actually click the buy or sell button, and that is your entry. Now, next, the S of CEST. That was the E. The S stands for your stop loss. This is where you are for sure getting out if you're wrong. Let's say we have price doing this, and you want to sell at the previous level of support. Let's say you get a good entry reason. Well, where is your stop loss going to go? Because if you don't have a place you're gonna stop the trade out, what if price just does this, continues higher, and you blow your account? A stop loss is very necessary. So what we need to do in that exact scenario is find a place for the stop loss, whether it's above where we entered our trade or above the previous resistance level. We'll talk more about that in a second, but a stop loss is absolutely necessary, and that's what the S stands for. Next up, we need a target. Where are we getting out if we're right? With our stop loss, we know where we're getting out when we're wrong, and one of the best ways to gauge a stop loss is, when am I wrong? if this trend is going to continue, it must continue before breaking above this level. Breaking above this level, which is the straightest line I've ever drawn, by the way, means that we are likely going to continue higher. So we don't want to see that. So a good place for a stop loss may be above that level, right? Next up, target. Where are we getting out if we are right? If you have price pushing up, and you buy right here, previous resistance turns into support. Where are you getting out if you're right? Are you setting yourself up with a 2-to-1 reward to risk ratio? Are you looking left for resistance levels? If these are questions you're asking yourself while you're in a trade, you're doing something wrong. These are things that need to be decided before you ever enter into the trade. You need to have your stop and your target already decided, because your emotional brain kicks in when you have your real hard-earned money at risk. You're not going to be making logical decisions. You're going to be making decisions based on how you feel. And if you do that, that is a direct path to losing money in financial markets. So CEST stands for conditions, entry, stop, and target. And this is how we're going to build the strategy you're going to learn right now. Let's talk about the whole strategy. To be honest, I have at least 5 or 6 different ways that I enter when all of those conditions are met for structured trading. But as you can see, this video is already a little bit over 45 minutes long, so I'm not going to have time to go over all of them. So what I'm going to do is just give you one of my favorite ways to enter when the conditions of a major level of either trend continuation or counter trend structure support or resistance are met. So once all my conditions are met with the 3-step process you have already learned, this is one of my favorite ways to enter. Simply put, it is either a hammer with a green candle afterwards or a shooting star with a red candle afterwards. But again, when it comes to the reason you press the button, your actual entry, the rules need to be rock solid. So I have a rock solid way that I define hammer and shooting star candles that isn't subjective at all. I don't have to do any guesswork when I'm looking for hammers or shooting stars. By doing this, or the way I do this, is with the Fibonacci retracement tool. So here I have my Fibonacci retracement tool. I'm going to pull from the bottom or the low of the candle to the high of the candle in order to identify a hammer candle. Once I do this, I need to see that the price, or not that the price, excuse me, I'm a little bit sick and starting to feel bad, so my words are getting jumbled, but that the entire body of this candle is above the 38.2% retracement. When I pull a Fibonacci retracement from the low of the candle to the high of the candle, as long as the body of the candle, the entire body, the bottom of the body, and the top of the body are all above the 38.2% retracement, then I count that as a hammer candle. So that is the way I define a hammer candle. I actually call it a 38.2% candle, but you can call it a hammer. I know that'll be a lot easier for most of you. So there's my definition of a hammer candle. Now, a hammer candle can be green or can be red. The only rules this must follow is that the entire body is above the 38.2% Fibonacci retracement. Before we move forward too much, let me explain how my Fibonacci retracement looks like this. I get this question all the time. And in order to make it look like this, whenever you get your Fibonacci retracement, the stock version of it from TradingView has all these others, all the other retracements on it. The only thing I do is uncheck the other retracements other than the 38.2. I turn all my lines to black, and then I take off this little background setting. When you have the background on, it looks really weird to me. So I just uncheck the background and uncheck all of the other retracement settings and extension settings so that I only have 38.2 checked. And 0.382, by the way, is 38.2%. So that's how I set up my Fibonacci. And this 38.2% candle must be followed by a green candle. The second candle does matter. The size of the second candle doesn't matter at all. It can be a doji. As long as it's green, that's all we're looking for. For a bullish entry, I'll go over that really quickly one more time. We're looking for a hammer, defined as a candle with the entire body above the 38.2% retracement when pulling the retracement from the low of the candle to the high of the candle. The color of the candle does not matter, but our entry is after we see a candle that is, in fact, a hammer candle and meets those criteria, and then the candle directly following that must be green to show us buying pressure after a hammer candlestick. That's what we're looking for in terms of the bullish reason for entry. throughout today's strategy tutorial. That's what we're going to be using throughout all the examples. So this is one of my favorite ways to enter inside of the conditions you learn inside of that three-step process to finding those major levels of support and resistance. That's the bullish entry. Let's take a brief look at the bearish entry. You should kind of know what I'm about to go with here. For a bearish entry, we're looking for a shooting star candle followed by a red candle. Now, my definition for a shooting star candle, just so I'm as objective as possible, and there is no doubt in my mind that I have a shooting star, and I'm completely consistent, is that I take a Fibonacci retracement from the high of the wick, the high of the candle, down to the low of the wick or low of the candle, and the entire body of the candle must be below the 38.2% retracement. That, for me, is a shooting star candle. This body can be any color. It can be green. That's completely fine. Does not matter as long as the criteria is met that the entire body of the candle is in fact below the 38.2% retracement, then I have a valid shooting star. For the exact reason I press the button, the actual entry is only if the very next candle is red. The close of that next candle is where I would be entering into the trade. For a bullish entry, the close of that second candle, as long as it closed, what's it got clothes on? As long as it's clothed? As long as it closes as a green candle, the close of that candle is where I place a market order as soon as that candle closes. So those are my entries and the entries that you're going to be using, that I'm going to be using throughout the rest of this video. When we get down to some charts and look at some examples, that's when I'll start to go over the stop loss and targets that I personally prefer. So if you've liked the video so far, I know we're 45 minutes to 50 minutes deep. Go ahead and click that like button for me. Subscribe if you're new and you enjoy this content. Let's go ahead and go down to some charts and take a look at a few examples of the entire strategy. And that'll also give me the opportunity to share with you the stops and targets that I personally prefer. Here we are on the Canada yen for our first example. We're going to take a look at a bullish trend continuation version of this strategy. So what's our first step? Our first step with any strategy is to identify the conditions that need to be met. Here is our conditions. It's the three-step process you've already learned throughout the video. So let's go ahead and do that. What trend are we in on the Canada yen? Well, as you can see, we start here. We have a high, a higher low, another higher high, another higher low, and currently we're putting in a new higher high. So with that being the case, we know we have trend continuation to the upside. Our next steps are to point out our trend continuation level of structure and our counter trend level of structure. Since you know this is a trend continuation trade, all I'm going to do is point out the trend continuation level. So let's go ahead and do that now. Where is our trend continuation level? Well, that would be right here. This level, that is the previous high that was broken, is in fact our trend continuation level of structure. Now, what's the third step? Ask ourselves, is it a strong level? So let's do that. Is this a strong level? Well, did it cause a major move out of price, or has it been tested multiple times? Once I scroll back, you can see that the answer to that is yes. This level has in fact been tested multiple times. So with that being the case, this is what my level would look like. So I have all of my conditions met. I've identified the trend, I have a trend continuation level, and that level is strong. After conditions, in our CEST process, what's next? Entry, right? So we just discussed what our entry is going to be. For a bullish trade, since we have our conditions met, our entry is going to be a hammer candle directly followed by a green candle right afterwards. So let's see if we get that once we press play. Here we have a market that's pulling back. We're continuing to pull back, and eventually we get into our area. Since we touched our zone here right at the 100 even level on the Canada yen, then we do in fact have a hammer candle here. How can we check that to be sure? With our Fibonacci retracement. So we take that Fibonacci retracement from the low of the candle up to the high of the candle. The entire body is in fact above the 38.2% retracement. Therefore, objectively, with absolutely no subjectivity, I know that I have a hammer candle. Now, I do not enter because of this hammer candle. I have to wait, and the very next candle must be green. As we press play here, you can see that that very next candle is green. So now, would this be an entry? Hopefully, if you've been paying attention throughout the rest of the video before this, then you said yes. So this would in fact be our entry. The close of that candle would be the entry. And now what I want to do is discuss stops and targets. We talked a little bit about this earlier, but the best place for a stop loss is to set it where you know you're wrong. There's not a worse feeling than being right about your analysis in the direction of the market, but then barely being stopped out before price takes off in the original direction that you thought it was going to go in the first place. So for that reason, we always want to put a stop loss where we think that we are wrong. In the case of this specific strategy, that is either going to be below the wick of the hammer / shooting star if it's bearish, but in this case, below the wick of the hammer candle or below the zone. Whichever one is lower on a bullish trade is where we're going to put the stop loss. So at times what we'll see is a hammer candle, and the wick of that hammer candle will come below our zone of structure, right? If that happens, the stop loss needs to go below the wick. But if we have a situation like we have here, where the hammer candle does not go below our zone, then our stop loss needs to go right below our zone. And here's the reasoning behind that. If price comes down into this zone of support more and then shoots up, there's no reason for me to put a stop loss below here because I'm still correct with my analysis because I assumed price would push up higher from this zone we pointed out. So that's why I want to be sure that my stop loss is either below the zone or below the hammer candle in a bullish trade, depending on which one is lower. So there's the rules for my stop loss. To keep things really, really simple for this video, for a target, I'm going to do 1.4 to 1 reward to risk ratio. Now, I have a much more complicated way of taking targets than this for the most part, but that's not something I have time to dive into, considering this video is probably already an hour long. But in this case, let's go with a 1.4 to 1 reward to risk ratio. That's what we'll use for the remainder of these examples. And if I click play, you'll see that this did, in fact, push the market higher using our conditions of finding a major level of structure, then using our entry reason of a hammer followed by a green candle, putting our stop loss in a place that makes sense, and then going for a 1.4 to 1 reward to risk ratio, which obviously you could have gotten more. You can take targets based on previous structure. Looking left, you can set yourself with a 2 to 1 fixed reward to risk ratio. In terms of targets, it's really up to you to decide what you would like to do. But for me, a safe bet and something that I've used multiple times in the past and something that I still use at times is a 1.4 to 1 reward to risk ratio. And what this normally does is sets me up with the ability to have over a 50% win rate and over a 1 to 1 reward to risk ratio, which over a long period of time equals profitable trading and a money-making trading career. Let's move on now to another example. Now we're on the dollar Canada. We're going to take a look at a bearish trend continuation version of this strategy. So what's our 3 steps? Our first step is to identify the trend, right? I'm not going to put it on the screen. At this point, you should probably have it memorized. They're not super hard, right? So we identify the trend. At this point, what trend is the dollar Canada in? Pretty obvious here that we are in a downtrend, creating lows, lower highs, lower lows, what we hope will be a lower high, and lower lows. So after this 1, 2, 3 move, which is what I call these, this impulsive move, pullback, break below previous low, we have a downtrend. If we're in a downtrend, I've already told you this is a trend continuation trade. Where is my trend continuation level? We're pulling back to it now. So the latest level of support that was broken is going to be my trend continuation level. And that's about right here in this area. What's my third step? To figure out, is this level strong? Well, there's not a big move out of price from this level initially from here, but this is a level that's already shown to have been tested multiple times. And if I scroll left, you can see that it's been tested even more as well right here. So that would validate this as a major level of structure resistance for me. And again, this is that previous support turned into resistance for trend continuation. So we have our conditions met. What's after conditions? After conditions, we need to know where and if our entry is going to occur. So what we're waiting on is to see price come up into our zone of structure resistance. That's trend continuation for this downtrend. And then we would want to see our entry reason for us to actually place a trade. So let's click play, see if that happens. We get to our level and we did not get any type of entry the first time we touched our level. Let's keep clicking play here and see if we get back to that level. We do in fact get back up to this level. And then right here, what happens? We're still inside of our zone, even though we're slightly above it. Again, these are not lines on a chart, but areas of support and resistance. And since we do in fact have this shooting star candle here inside of our zone, again, we can be sure of that by using our 38.2% retracement. Obviously, the body of that candle is below 38.2% of the entire candle. So we have a valid shooting star. What's the next step? We need a red candle to show confirmation of selling pressure after this candlestick pattern. And there we go, red candle. So at this point, this would be the actual entry. This is where we would place the trade right after the close of that candle. And what is our stop loss going to be? Where would you put the stop loss? At what point in this situation are you wrong? Well, if this bearish shooting star is what caused the selling pressure, as long as we stay below the high of that shooting star, then we're still considered to be going to push down. We're still considering this a good trade as long as we stay below that level. So that's where I would be placing the stop loss. It's just above the high of that shooting star. Next up, we do our 1.4 to 1 reward to risk ratio for these examples. Click play. And as you can see, price did in fact fall from our important / strong area of resistance that used to be support for trend continuation on this downtrend. Now let's take a look at a couple of counter trend examples of this entire strategy. This time we're on the pound yen 4-hour chart. What's the trend we're in? First step, right? Identify trend. This is obviously a downtrend. We're making lower lows, highs. Gosh, this dyslexia is kicking my ass today. We're making lower lows as well. So with that being the case, we are in fact in a downtrend. This is a counter trend trade in this example. So what are we going to be looking for? We're going to be looking at the lowest lows price has created in this downtrend, which in fact are right here. Then we're going to scroll left and see the next area price is going to hit as an area of support or resistance, in this case of support. So we're going to pull down to that area and try to get as many touches as we can. For me, this area looks about like this. So this is going to be my area of structure. So I've identified my counter trend area. I've ensured that it's been a strong level because it has pushed the market around dramatically and also been tested multiple times, which is step number 3 of our conditions. Now that conditions are met, we're looking for entry. Since this is going to be a bullish trade and I'm looking for a pop to the upside, my bullish entry is what? My bullish entry is a hammer candle followed by a green candle. So let's click play here and take a look at what happened here on this pair. We have price coming into our zone. Next up, we do in fact have a hammer candle. The way we know that's a hammer candle is by pulling our Fibonacci retracement from the low of the wick to the high of the wick and making sure the whole body of that candle is above the 38.2% retracement. Since it is, we can click play. And as long as this is a green candle, then we enter on that candle. I say we, don't take this as financial advice. I'm just showing you examples of things that have worked for me. Every time I say we, I get really worried about it because I'm like, I'm not really telling you how to trade. I'm more so going through things that have worked for me. If this is the case, where would our stop loss go? Where would my stop loss go? Did it again already. My stop loss would go at a point that I think I'm wrong. If this is my support area, then the point I think I'm wrong is if we get below it. If we get below that area, then price is probably going to continue falling. So I want to ensure that I give myself enough room and put my stop loss in a safe place, which is right below my zone. After that, 1.4 to 1 reward to risk ratio, which is already there. So let's go ahead and click play. And price comes up to hit that 1.4 very, very easily on this trade. Next up, for our final example, we're going to take a look at a bearish counter trend trade, and that trade is going to be on the Euro Canada. So here on the Euro Canada, what trend are we in? Pretty easy to identify this one. We have swing low to a swing high to a higher low to a higher high. After this 1, 2, 3 move, excuse me, after this 1, 2, 3 move, we now have an uptrend. Since we have an uptrend and this is going to be a bearish counter trend trade for this example, we're looking above where price is and to the left for our counter trend level of structure. So we've identified trend, now we're looking for level of structure. We scroll left from where price is now, and it makes it a lot easier if you just put a horizontal line on the highest point price has gotten to in this uptrend, which is right here at 1.5029. Above that, where's the next level of resistance? hopefully you were pretty easily able to spot this level right here, which in fact would be the next level of resistance. The zone would look something like this for me, depending on if we get multiple touches. I would probably try to encapsulate this touch as well and bring this up a bit. So this is about what my zone would look like here on the Euro Canada. So with that being the case, what I'm looking for, and again, this is definitely a strong level. So number 3, the third rule in our 3-step process is that it must be a level that has pushed the market around in a major way, and that is the case here. Plus, this level has been tested multiple times as well. So all those factors coming together to equal my conditions are met. Since my conditions are met, my next step is what? CE, entry. So I'm waiting for price to get to this level, waiting for a shooting star followed by a red candle. That is right. Let's go ahead and push the market forward. See what happens here. We get into our zone. After that, we get what looks to be possibly a shooting star candle. Now, this is where a lot of traders mess up, is not having those objective rules, even for candlestick patterns. People can say shooting star and hammer, but if you don't have some type of objective rule for a shooting star or a hammer candle, it's going to be hard for you to identify when it's like this, when it's not really apparent, when it's not exactly like a shooting star or a hammer candle. So the way I do that to keep things objective, as we've already discussed, is with this 38.2% retracement on my Fibonacci retracement. And as you can see here, the entire body of this candle is in fact below the 38.2% retracement, giving me a valid shooting star candle. Next, we need to see a red candle, otherwise we can't place the trade. Boom, we have a shooting star candle at a major area of resistance and selling pressure afterwards. That selling pressure afterwards, or red candle, whatever you want to call it, that red candle is going to be our entry. The place we know we're wrong at this point is above our shooting star candle. So that's where our stop loss is going to go. That 1.4 to 1 reward to risk ratio looks like this. And if we click play, you can see that that trade did work out. Now again, in terms of entries, stops, and targets, stops I would keep similar to what I'm doing, but targets are completely up to you. You can get much more than 1.4 to 1 reward to risk ratios and still have this be a profitable strategy. In terms of entries, there are tons of different ways you could enter the market. This is just all I have time to go over in this specific video. I have something that I think is extremely beneficial for anyone that's trading right now to share with you in just a second. But before I do, I want to take a look at 2 more trades. One of them is a live trade I'm in, and one of them is a trade I took using this strategy 2 days ago. So here on the Canada yen, it might have been 1 day ago. When was this? Monday? On the 1st of June. It's the 3rd of June now. Might have been like Tuesday or Wednesday. I can't remember the day that I actually took the trade, but here is price pushing up to a counter trend level of structure. So we have all this bullish momentum pushing above, breaking above, plenty of resistance levels, putting us into what I would consider an uptrend. So a counter trend level would be this level of structure resistance that caused a major push down, right? After that happened, what we get here on the Canada yen is a nice shooting star candle followed by a red candle. So with this being the case, I went ahead and placed my trade here on the Canada yen. It looked a little bit like this. My stop loss was here. My target was at a 1 point. Well, my target was a little bit more than this, but somewhere around a 1.4. Irregardless, let's click play. And that's what happened. So I just wanted to show you this trade so that there's no confusion in people thinking, or you thinking, that this is a strategy that always wins. Showing winning examples is just a lot easier than showing losing examples, but this is a strategy that, like all other strategies, has losing trades as well. Now let's move on and take a look at a live trade I'm currently in. Here on the New Zealand dollar 1 hour chart, we have a trade we're currently in based on this exact method. We have a push up breaking above resistance, putting us into a slight uptrend. So then we're looking for a counter trend level of resistance. Scrolling left, here is our counter trend resistance that caused a major move out of price. We then get up to this level. We put in our shooting star, followed by a red candle, entered there, stop loss right above the swing high. We're currently sitting at about a 2 to 1 reward to risk ratio on this trade. Now, since you've stuck with me throughout this entire time, I want to share with you something that I call the ladder of trading success. And if you've been around the channel for a while, you know that I really like using diagrams, especially triangles. So let's draw out a triangle here. And what we have in trading is about 80% of traders lose money, or blow their account. A solid 80% of traders never make it to even break even. Instead, they consistently lose money, they blow multiple accounts, they're struggling for years and years without ever becoming profitable. That's where about 80% of people lie. Then we have about 15% of traders that get to a point of break even. They never really make money. They never lose at all. They've done enough studying. They have educated themselves enough to be break even. That's about 15% of traders in general, just a big generalization. And about 5% of traders are traders that actually make money. Now, this is a really scary diagram if you think about it, because more than likely, right now you're in either this 80% or this 15% area. But the good news is there are little ladders you can take from, let's say, the 80% of people that are losing money. There's ladders you can take to get to the next level. And these ladders are different parts of educating yourself. So, for example, if you're at the bottom 80%, you probably don't have a strategy that makes money over time. You probably don't have a good handle on risk management, and you probably don't know much about trading psychology. But each level, again, has a little ladder that you can climb to get up to the next level. And these ladders consist of the way you educate yourself. They consist of lessons you must learn as a trader. Now, there are three main lessons that can push you up these ladders and take you from the 80% of people that lose money to someone that's at least break even, and then take you from the person that's break even to someone that's in the top 5% and making money. Let's discuss the different parts of trading you need in order to build these ladders and climb your way up to the next spot. And to do so, you guessed it, I'm drawing another triangle. So this is what I call the triangle of trading success. What we have, if we have this triangle, what we have inside of it is all the traders that are actually making money. These are profitable traders. We're going to call these top 5%. Any trader that's in the top 5% you've ever met has mastered these three skills. Anyone you ever watched on YouTube that's in the top 5%, meaning they're consistently profitable, they've mastered these skills. A strategy that makes money over time, a risk management plan that keeps them out of their emotions, and they understand trading psychology. And another word for this is they understand how to stay disciplined to their trading plan. Discipline to the strategy they're trading, and discipline to the risk management plan. They're not jumping around from strategy to strategy to strategy. They're not using a 1% risk on one trade and then a 10% risk on the other. They're not jumping around with any parts of their trading. Instead, they have a great handle on trading psychology and a great handle on their discipline. So right now, throughout this entire video, what I've attempted to teach you is a strategy that for me has made money over time. So that's something that you now have, but you can have this, a strategy that makes money over time, and you could still be in that bottom 80% of traders that lose money. And you may be asking, Stephen, how in the hell can I be in the bottom 80% if I have a strategy that makes money? Well, you may have a strategy that makes money, but you don't have a good handle on your trading psychology or discipline. So you might be trading this strategy that's proven to make money in the past, that should make money in the future, but you're also trying out different strategies from different people, or trying out other strategies in general when this specific strategy goes through a losing streak or a drawdown. That is a recipe for you to stay in the bottom 80%. In order to be profitable, we have to have our strategy that makes money over time statistically. We need a good handle on trading psychology and discipline. And another reason you may still be in the bottom 80% is even if you have a strategy that makes money over time. These strategies that make money over time provide an edge over time. They don't work 80-90% of the time for the most part. There may be strategies out there that do, but for the most part, you're going to have something between 40% and 60% accurate that gives you between a 1-to-1 and a 2-to-1 reward to risk ratio. So this is going to be the formula, I guess you could say, for a successful strategy in most cases. With that being the case, even at a 60% win rate, you have a possibility of losing 5 to 10 trades in a row. Now, if you're risking, your risk management isn't on point, you don't have a good handle on risk management, and you're risking 10% per trade, if you lose 10 trades in a row, you're going to be minus 100% in your account, meaning you're going to blow your account even though you have a good strategy that makes money over time and good discipline and trading psychology. You can have those things but have poor risk management and still lose money, blow your account. So that's how you stay in this bottom 80% that never really makes money and constantly loses money and possibly blows their account. Now, one of the stepping stones to get from this 80% to the 15% that are break even is learning the next skill. So let's say you have a strategy that makes money over time. Add one of these skills to that. If you can add risk management to that, chances are you'll stay somewhere around break even if you have bad trading psychology and discipline. If you can take this strategy and add trading psychology and discipline, as long as you don't do something major like a 10% risk per trade and you have a decent handle on risk management, you can stay around break even. Now, the way you get from this break even mark to the top 5% of traders that make money over time consistently is by mastering all three of these skills. It's by mastering a strategy that makes money over time, by having a good risk management plan that keeps you from blowing your account and keeps you out of your emotions while you're trading, and by having a good handle on discipline and trading psychology so you're not jumping around from strategy to strategy. You're not moving your stop loss because you're scared of losing money in that trade. You're not moving your target around because you want to get rich quick and you're trying just to get out when you have money. You need to be disciplined to your strategy and disciplined to your plan. Along with that, you need a good risk management plan, and the strategy must make money over time. Otherwise, you're pissing in the wind, as they say here in the South. With that being the case, if you would like to learn more about strategies, risk management, and trading psychology in a really systematic and organized way, we do have some space available in the TTC Forex University. That's our flagship program now. It is linked in the description, or you can go to www.ttcfxuniversity.com to learn more. That is a full course. It's personal mentorship from me. Any questions you have, it'll be me answering those questions personally if they're questions about trading. Along with that, the course comes with a 30-day money-back guarantee, a best setups of the week video showing you the areas of structure I'm paying attention to trade in, and much, much more. If you want full details on that, again, it's linked in the description, or you can go to the website you see on the screen, www.ttcfxuniversity.com. Hopefully this video has given you everything you need to climb the ladder of success and go from someone losing money to someone in the top 5%. I've done my best to make sure that's the case. So if you feel like it's been helpful, be sure to click that like button. Be sure to subscribe. If you are new, comment if you made it to the end. I'll like every comment that says they made it to the end because this is like an hour and 20-minute video. Thank you. Great job. You are focused enough to become a profitable trader if you watch this whole thing, and I cannot wait to see and hear from you about how this video helps you in your trading journey. I wish you all the best of luck on your future trades, and I'll catch you in the next video. See you soon.